Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. Right before making this video, the US Fed raised its interest rate by 0.5% to a range between 4.25% and 4.5%. In the upcoming year, the US Fed is planning to raise its peak rate, also known as the terminal rate, to over 5%. Of course, the main purpose is to bring the US inflation back down to the 2% target and to prevent the current high inflation from being entrenched in the US economy. The US inflation has started coming down in recent months, but it's still near a 40-year high. Here's the biggest problem that concerns most investors. Most investors' portfolios are down more than 20% in the past 1 year because of the US Fed's aggressive rate hikes and quantitative tightening, also known as QT. For example, the S&P 500 is down 20% from the most recent peak, and the Nasdaq 100 is down even more at 33% from the most recent peak. During this period, when inflation is still near a 40-year high, the only sector that's performed very well is the energy sector. For example, this energy ETF grew as much as 56% in the past 1 year. The US Fed's aggressive rate hikes and a high peak rate will continue to impact the market going forward in 2023 and 2024 until the US inflation is back down to the 2% target. This means it may still be a bear market in 2023 until the US Fed stops raising interest rates and starts pivoting. So in this video, I'm going to talk about when will the US Fed start pivoting and start lowering interest rates, when will the US stock market start recovering, and what stocks I will be buying in the upcoming months. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we will be able to stay independent and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Take a look, let's start. So when will the US Fed start pivoting and start lowering interest rates? I think this is a very important question because many investors want to know when the US stock market will start rebounding. Generally speaking, the S&P 500 and many individual stocks will start recovering very quickly when the US Fed stops raising interest rates and starts lowering interest rates. This is because lowering rates will increase borrowings for both consumers and businesses, increase economic growth, encourage business spending and more hiring, and of course increase consumer spending. The US Fed is still raising rates aggressively and maintaining a very restrictive monetary policy stance because the US inflation is still far above the 2% target. For example, the recent inflation data shows that the core CPI inflation, excluding food and energy, was 6% in November. The PCE inflation was 6% in October. Both inflation measurements are still far above the US Fed's 2% inflation target. More importantly, at the time of making this video, the US labor market is still very tight. The US unemployment rate is still very low at 3.7%. Outside of the tech industry, many businesses are still increasing wage for employees because many have a hard time hiring more employees to fill positions. A very tight labor market where the demand for labor is higher than the supply of workers means that it's a lot harder for the US Fed to bring inflation back to the 2% target. High wage increases and labor shortage are two of the biggest factors that are contributing to the high inflation now. I think it's important to understand this because it means that it will likely take the US Fed longer to bring inflation back to the 2% target. This will not happen right away in 2023 and 2024. This means the US Fed will not pivot and start lowering rates until at least 2024. The US Fed Chair Jerome Powell said this in a recent FOMC press conference. I'll share with you the most important parts he said.
Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
Here's the important part. The rate setting committee, FOMC, predicts that the terminal rate or the peak rate will be over 5% in 2023. This will slow down the US economy even more, decrease consumer demand, increase borrowing costs for both consumers and businesses, increase the unemployment rate to above 4%, cause many companies to have lower earnings, and of course negatively affect stock prices and housing prices even more. The FOMC predicts that they will likely start lowering rates in 2024 if inflation starts coming down in a sustained way toward the 2% target.
We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation, and we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
In this FOMC press conference, Jerome Powell said that most of the FOMC members believe that the US Fed is not at a sufficiently restrictive policy stance yet. This means the US Fed will continue to raise more rates throughout 2023 to reach a peak rate of 5.1% or more, depending on future economic and inflation data. In comparison, at the time of making this video, the Fed funds rate range is between 4.25% and 4.5%. Jerome Powell said this.
I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed.
According to Jerome Powell, there will not be a rate cut in 2023. The US Fed will not pivot in 2023. He said this.
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
I want to share with you the most important forecast from the US Fed's summary of economic projections here. The unemployment rate is expected to increase from 3.7% to 4.6% in 2023 because there will be more rate hikes going forward. The US economy will likely head into a recession in 2023. The PCE inflation is expected to drop from 5.6% in 2022 to 3.1% by the end of 2023. 2.5% by the end of 2024 and 2.1% by the end of 2025. This means it may take at least 3 years for the US inflation to drop back to the 2% target. This shows the US Fed will not pivot and decrease rates until at least 2024. If you're an investor, you want to know when will the US stock market start recovering. Here's my prediction. I think we should still expect it will still be a bear market in 2023, simply because the US Fed is planning to raise rates to above 5% and maintain the peak rate for at least several quarters until they see the US inflation drops down significantly toward the 2% target. At the same time, the US unemployment rate is expected to increase to above 4%. Consumer demand will slow down even more because of much higher borrowing costs. Many companies will report lower earnings because of high inflation, higher interest rates, lower consumer demand, slowing down in the global economy, and many macro headwinds such as the war in Ukraine. I believe the US stock market, as represented by the S&P 500 and the Nasdaq 100, will start recovering quickly when the US Fed starts pivoting and lowering interest rates sometime in 2024. Of course, I cannot predict the exact timing, but I do believe the market will eventually recover when the US inflation drops back toward the 2% target, which will take several years. According to this forecast here, the US Fed expects the US inflation will be near 2% by the end of 2025. I believe the bear market will continue in 2023 until the US Fed starts pivoting sometime in 2024. There will be more rate hikes in the upcoming months. The US Fed will increase its peak rate to above 5% in 2023 and keep it there for a while until they see inflation coming down in a sustained way toward the 2% target. To take advantage of this bear market, I will be investing in many dividend growth stocks in the upcoming months because I believe many outstanding businesses are undervalued now. I like to invest in many outstanding businesses that are below their intrinsic business values, and I like to invest for the long term to reduce risk. I like the buy and hold strategy. Eventually, the market will recover and reach a new high again once the US inflation drops back to the 2% target. Instead of timing the market, I like to use dollar cost averaging to buy more stocks or ETFs every month. I'll show you an example here. In the upcoming months, I will likely invest in more Apple, Lam Research, ASML, Visa, and MasterCard because I believe they're outstanding dividend growth businesses with great fundamentals, great management, and large economic moats. Also, I believe they're likely undervalued based on my intrinsic value calculations here. I always use this intrinsic value calculator here to calculate each stock's intrinsic value, so I will know when a stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic value calculator, you can download it from my Patreon blog. The link is in the video description. Right before making this video, I decided to buy 10 more Tesla shares. I believe Tesla is undervalued mainly because of the macro headwinds such as high inflation, high energy prices, and central banks increasing rates around the world. In my opinion, Tesla's fundamentals, economic moats, competitive advantage, and long-term prospects have not changed, even though Elon Musk is currently distracted by Twitter. Elon Musk will eventually need to hire a new CEO to run Twitter, so he can focus more time on Tesla. Management gave this outlook. I believe this outlook represents Tesla's best case scenario. Management said, "We plan to grow our manufacturing capacity as quickly as possible over a multi-year horizon. We expect to achieve 50% average annual growth in vehicle deliveries. The rate of growth will depend on our equipment capacity, factory uptime, operational efficiency, and the capacity and stability of the supply chain." There are 3 case scenarios in this calculator: worst case, normal case, and best case scenarios. Under the worst case scenario, we're assuming Tesla's free cash flow will grow at a CAGR of 30% over the next 5 years. If we forecast Tesla's free cash flow over the next 5 years and discount the free cash flow to the present day, Tesla's intrinsic value should be around $529 billion for the entire company, or $153 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're assuming Tesla's free cash flow will grow at a CAGR of 40% over the next 5 years. Then Tesla's intrinsic value should be around $749 billion for the entire company, or $216 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're assuming Tesla's free cash flow will grow at a CAGR of 50% over the next 5 years. Then Tesla's intrinsic value should be around $1 trillion for the entire company, or $300 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Tesla's intrinsic value should be around $221 per share. In comparison, Morningstar estimated Tesla's intrinsic value to be much higher at $250 per share. This means I believe Tesla is likely undervalued at the time of making this video. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.